me get this right the third time round. Okay, so we're back. It's 9th of December. And we're going to see what happened in November in terms of dividends. And I got a bit of an update for you as well. So, we kicked off the month with two payments for primary health properties. So this is the property income distribution. And this is the ordinary share one then, right? So that came to a total of, what was it? Let's have a look, yeah. I've got £28.47. Assuming that's correct, right? Then we had 4 sites sold there was £2. There's only 100 shares there. Then we had the 4 bond ETFs, right? So we've got, actually these are, I should say, these are government bond ETFs. That's what I should do. So we've got Vanguard USD Treasury, only 2 shares of that one, 14p. Eurozone, which is the euro. So that's 2 shares there, 10p. And then Vanguard USD Emerging Markets, 2 shares, 41p. Then we got the UK Gilt, which is UK government bonds, 10 shares, 65p. Then GCP Infrastructure comes in with £29.75, 1,700 shares there. That was improving in terms of price, and then it seems to have slided down since. Basically, there was a bit of optimism once Labour came in, and then since then it's just sort of dropped down. So, a bit of a pump, and then a gradual fall off. Diverse Income Trust is nice and stable in terms of price, and £1.20 for just 100 shares. 100 shares again for Greencoat, £2.50. Then we've got the US Short-Term High Yield Corporate Bond Index, £11.3 for 170 shares. In fact, I was in the green earlier. Yeah, one of the rare ones. And then PIMCO Sterling Short Maturity, which is short-term bonds and I want to say government bonds actually, but might just be sterling bonds in general. Could be a mix of government, corporate, so forth. So that came to £76.71 and a milestone again of £1,111.11 in terms of dividends. Which, if you were to add to, say, the abysmal performance of the portfolio so far, would not be too bad a difference. So, have a quick look at the portfolio and see how things are doing. So, I will do a end of year net return so far, but at the minute we've got 4217. Just keep it at that. Right, so minus 4217. We can add in the 1111, give me a net negative return of £3,106 in the red. So if you add back the dividends received, it's not too bad. Now I have taken withdrawals out of the fund this year, out of the portfolio, because a couple of things have one thing's come to my attention and my realization. I've had to sort of adjust to it now, and the other then is something I'm now trying to do which I haven't done before. So a few times I found myself thinking, right, okay, 10%, this doesn't seem like much, which it isn't, right? If you're on low income, it's not much. Quite good income, it's quite a bit, but it's not much when you're on low income. I get paid weekly, so it doesn't, like, come into a nice bigger chunk on a monthly basis. It's on a weekly basis. And it's nice to put away 20%, but then when you want things, you either have to use a bit of debt to get them, or you can dip into, say, 10% of your income you shut aside for just wants and needs throughout the year. So let's say I saved £1,000, but I've got then £1,000 aside for things I might want to buy or need to buy throughout the year, and then not have that particular amount of money just half disappear. It's kind of what's been going on here. So that has finally sort of come to my attention. I do it myself all the time. I want this one now, suddenly need this, and I don't have the spare cash to dip into to do that. Now, one of the things I've decided I want to start doing this year, because I had a change of circumstances where I've moved, and I've moved from the edge of a town to further away from it, and I can't just simply walk into town, get a taxi if it's raining, or maybe decide to do a bus. I can still get a bus and taxi in town, but it's further away, so it's going to cost more. So what I finally decided to do, because I'm more out of the way, more of a reliance on lifts. If I want to go and see the family, I can walk, usually to walk a distance. It's further walk, I can do it now and again. But basically, it's a case of I need to now look at driving, because I've never driven before. And I've decided to start doing so now this side of Christmas. And so, because I put away too much money in the past, I got a choice: either take out some of that money now gradually, which I have done a little bit in terms of dividend income and the capital. It's going to become more capital now the next few months. Or I can kind of more or less leave it as it is, and then from the beginning of January on, no longer pay into the portfolio. Just leave what I've done more or less there. Might me want to take it down to about 15 grand maybe, don't know. Take it down to 16, who knows. And just leave it there, perform whatever. Because I found myself in a situation where at one point this year, beginning of this year, I'm like, I don't understand how some of these capital market shares really sort of work, because some of them, if they based on the value of investments or value of, say, let's say a portfolio, a REIT portfolio. It's got 100 million portfolio. Its change of fair value has gone down 10 million. So now it's 90 million, right? That 10 million gets reflected in capital, whichever capital section on the shareholder equity, right? And then they've got the revenue. So there's a revenue column, there's a capital column, and on income expenses, profits or loss statement, they've got the changes in portfolio value as an income item. It's more of a comprehensive income item because that does then affect the shareholder equity, which is a reflection of the difference between liabilities and assets. So if your assets have gone down 10 million in value, then your liabilities are going to come up, which is going to squeeze the equity a bit. So you can expect the equity to go down in 10 million, and then again if they pay enough dividends. But with VPC, especially lending investments, which I initially thought was going into a wind down, it's not. Turns out Aberdeen diversified income, but by here is, right? This one is going into a planned wind down now this year, as was the Aberdeen logistics income. So I sold that one, but I'm going to actually let this one play out. It's only £43 in there. Let it play out, see what happens in the wind down effect. Right? But I honest to God thought this one was that. It's not. It's not going. There's no plans. There's also plans to come under PwC again. They want to allow PwC to have a run-in of the thing again. So look at the other day with the website yesterday. Alright, seems it's not like a debt management or an administration or anything like that. So they seem to plan to continue at least for another year. So either the share investors go, nope, we don't like this anymore, we're out. Because that is now my worst performer, where it used to be regional REIT. And regional REIT at the minute is holding a 43% down. I'm not going to commit anymore because I've lost too much, right? Just going to see how this plays out, because the government tried twice to kill this thing. Then corporations decided that we don't want the offices anymore, and then they all said, no, we want to go back to the office. So these now got like 98% occupied again. So hopefully next year this might turn around. But with higher interest rates and debts and different this, that and the other, they're going to be more affected. But you'd have thought, especially lending, at least with the interest rates being up, it would have been alright. But somewhere along the way, the desire for this has just gone down and down and down and down. So it's either wait and see till they decide to just delist, because they don't have enough, or this is just going to actually just continue to pay out the dividend. I don't know. So because I've had too many of these, you know what I mean, like, okay, Aberdeen's had a bad year, right, but certainly a bad quarter, but it's been down ever since I bought the damn thing. I bought this thing originally at 307 pence a share back in 2020. And it keeps going down to the lowest point I paid last year or the year before. But it's not a business, it's asset management. And a lot of these are under asset management. So maybe that's a little thing to me, to stay away from asset management and just take the basic stocks, basic companies. You know, I know what the gross margin is, I know what the operating margin is, I know what the current and non-current ratios are for the balance sheet. That's the one. So yeah, that's the income, and this is just a sort of changes are coming in terms of whether I'll be putting more money in or not, and maybe it's time to sort of throw in the hammer come next year. But if I reach that 5 year where it's just all gone bad, I have generated quite a bit. I mean, if it wasn't for that return of capital, right, if it wasn't for that, there'd be an extra grand here, because that return of capital caused me to have a negative balance, because the shares were now worth it, because it all came back to me. Had I known they were going to do that, I'd still have a grand and something here as a realized profit and loss. In terms of transactions, yeah, that makes sense. I've put this much in, I've taken this much out. Right? Quite a fair bit lately, you know, to do it. That was just to cover a load of, cover about 6 driving lessons. It was 50 quid a week, hour and a half, because I'm a bit away from some of the industrial estates to start me off on, just to get used to this and the other before I end up going to the road. Which means I can then do an hour session at 30 odd quid an hour. So it's cheaper then, right? But this is the situation I'm in. So I'll see you all next month. And this is just a dividend update and portfolio news. There we go. See you all next month. Enjoy. Oh, and do not do what I do, okay? I'm the worst. As I keep saying, I am the worst investor on YouTube. Do not do what I do. Good luck.